Good morning, everyone. Happy Monday to everybody. This is Tony Butler with Insurance Agency Marketing Services. I'm one of the life sales directors here, and I want to thank everyone for joining our webinar today. Today, I have Andrew Herrera, who is Regional Vice President with North American, and our topic that we're going to be discussing is finding tax advantage opportunities in 2021. As always, before we get started on our webinar, I want to point out a few things that we offer here at Insurance Agency Marketing Services. Um, Great news that we have our top producer summit that is coming up in 2022. And that's going to be a cruise that's going to be available for our top producers. We already have one. Advisor that has qualified for the cruise, and we have several others that are on the cusp qualifying for the cruise. Qualifications is 4.5 million points. Qualification period is from December 1st of 2020 all the way up until June 30th of 2022. As you can see, here are some of the destinations for the cruise. So if you're interested in more information or would like to know where you stand as far as the cruise, I do have a polling question available here that I'm going to put up. Make sure that you do respond because I would love to get more information out to you. So let me launch that real quick. And if you guys could respond to that, that would be awesome. And I'll leave this up for just a little bit um, and make sure that I leave enough time for you guys to respond to that. All right, I'm going to go ahead and close that down. All right. Next, for our new producers, we do have new producers builders. These are for agents that have gotten appointed with us the first 180 days. Um, we do have different levels that are available for you in terms of additional perks, if you will. We have the 100,000, 250,000, 500, 750, and 1 million dollar level. That's paid premium. And as you see, there are several things that you can obtain hitting certain levels, whether it be 1,500 piece mailer, 3,000 piece postcard mailing. We do have a Ritz-Carlton package. We do have some assistance for you as far as a social media campaign, things of that nature. So if you have questions in regards to our new producers builders, please don't hesitate to give us a call. Any one of our sales directors can answer any questions that you may have for that. We also have the IMES Business Builders, which is a referral program that we have here at Insurance Agency Marketing Services. So any agent that you refer to us and they get appointed with any of the carriers that we work with, we do provide you, the referring agent, I should say, a $50 one-time bonus. Any subsequent business that is submitted from that agent provides you additional perks in terms of additional monies, whether it be life target premium, indexed annuities, single premium life, or MIGAs. So if you have any questions regarding our IMES Business Builder, again, any one of our sales directors would be more than happy to talk to you about that in greater detail. We also offer back office support here at IMES. We like to say we want to help you work smarter, not harder. So what that entails is assistance with life and annuity quotes. We do offer paperless contracting, and we do have top sales expertise and coaching. So we want to help you all the way from submissions to commissions with your sales. We have a 24/7 website. And with the current pandemic that everyone's dealing with, the struggle has been getting in front of clients. So we have a couple of platforms that allow you to do electronic applications. One is through our iGo eApp solutions if you are a life agent. That is available on our IMES website. Other tools that's available on our website, we have a term and universal life quoter. You can access, forms, Our annuity and long-term care product grids are available on there as well. Another platform that we have for electronic applications is our Firelight platform. You can register for Firelight from our website, and as you can see here, with Firelight, the carriers that we have available through Firelight and the carriers that are coming soon. So any of these carriers that are not available, if you are a life agent, if you don't see on the Firelight list here, chances are they're available on our iGo eApp solution. So we have a couple of platforms available for you there to submit electronic applications. If you need assistance with getting registered for Firelight or getting registered on our website, we would be more than happy to walk you through that as well. We also have creative marketing solutions available for all our advisors. We help you with turnkey agency or digital solutions. And what that means is we're here to assist you, whether it be with handouts or flyers or newsletters for your business, logo designs, you're looking for help with brochures, or if you're looking to get into the digital marketing space, we can help in regards to personal website assistance, social media consulting. What I would strongly suggest is if any of this does interest you, to reach out to your sales director. We would love to do a marketing analysis where we're going to do kind of a comprehensive drill down of your business, what you've been doing in the past, what you're looking to do in the future, and come up with a strategic plan to help you grow your business. We do have a retirement analyzer available for our agents as well. It's free to qualifying agents. And what that does is it helps you answer questions from your clients, such as when can I retire safely without running out of money? How would it affect my family if I enter a nursing facility? How would it affect my family if I were to die prematurely? That is available free for qualifying agents. We can provide you with more information on what it takes for that. There is a charge for it if you're not a qualifying agent, and we could also answer questions in regards to that as well. We do have an IAMS wealth management team available for all of our advisors, and the wealth management team is there for your higher net worth clients. They're designed to help you, the advisor, increase your revenue, improve client retention, and strengthen your client relationships. So if you have questions or you do have some higher net worth clients that you're looking for other opportunities for, please reach out to Charles Jr. and his team. They'd be more than happy to provide you with additional information on how they can help you. Let me go back with that. I was one slide ahead of myself, just so that you know when we end the webinar here, we'll open it up for some questions. The life department, it does consist of 3 life sales directors, myself, Justin Ford, and Jess Riley. As you see here, here are our emails, or you can reach out to us at 800-255-5055 and just ask for the life department. With that, I'm going to turn it over to you, Andrew. You still there?
I'm here. Thank you, Tony.
All right, there you go.
Awesome. And let's see, show my screen here. Give me 1 second while I upload this. And Tony, let me know if you can see my screen okay.
Yep, I can see it.
Perfect. Thank you, Tony. Appreciate the opportunity, and thank you all for joining myself and Tony with IAMS this morning. As Tony mentioned, I wanted to take this opportunity just to talk about some tax advantage opportunities in 2021. I think that given the current environment, now is as good a time as any to talk about, some of the changes that are going on and highlight what I believe is some life insurance-based opportunities this year. Tony mentioned, my name is Andrew Herrera, Regional Vice President with North American on the life insurance side. And again, appreciate you guys taking time out of your morning to join us. The agenda that I want to cover this morning, before we dive into the opportunities, is I really want to give a little bit of a backdrop as to, some of the regulatory changes that we've seen in the life insurance space, specifically in the IUL space, the last several months, to serve as kind of the backdrop to North American's product and more so the industry and where it's at, some of the changes you've probably seen in the last few months. So I'll go through this pretty quickly because I know a lot of you are probably familiar with the changes that have affected Index Universal Life. First and foremost, what we saw last fall was AG 49A. AG 49A was basically a modification to the original AG 49 rule. Those of you who've been in the life insurance space and have sold IUL the last several years, you probably remember a time where IUL was almost like the wild, wild west, right? You could illustrate almost as high as you wanted to, or as high as the carrier would allow you to. And there was really no guidance on what that rate that you're illustrating would be. So AG 49A was implemented several years ago, and it basically gave carriers more alignment as far as what they could illustrate using a 25-year back test, so on and so forth. Despite AG 49A being implemented several years ago, a lot of carriers still decided, hey, how do we get around AG 49A? So you saw the rise of kind of these mega multiplier buy-up caps type solutions and products. So AG 49A, again, which is the second regulation on this, which was implemented late last year, said, okay, we're going to limit the ability to illustrate these buy-up cap rates and multipliers on IUL products. The other big change that it did is on the loan arbitrage, so solving for income. It said instead of illustrating a loan arbitrage of 100 basis points, that's now going to be limited to 50 basis points. What did not change is the existence of buy-up caps and multipliers. So even though you can't illustrate that on those products anymore, you can still have it on the products. Specific to North American's IUL, here's where we were in a pre-AG 49 environment. So last August, North American's Builder Plus 2, accumulation IUL would have been ranked number 11. And in large part, that was due, again, to a lot of carriers that had these buy-up, caps and multipliers were ahead of us in the game. And after the AG 49 changes, you can see that North American went from number 11 to number 5 in terms of competitive positioning. Big jump, right? And that's, again, because a lot of other carriers who had those multipliers, buy-up caps, had to change that. And so you can see that their ranking really dropped dramatically. The other thing that I want to highlight is what we saw kind of as a surprise to many in the industry, and that was the 7702 changes with the Consolidated Appropriations Act. That was kind of snuck in, again, at the last minute, unbeknownst to a lot of carriers. Now, there were some people lobbying for this. We just weren't really sure if it was going to happen. And again, it got approved in this Appropriations Act at the last minute. What it was a big change to how life insurance basically is calculated, and specific to the interest rates that carriers have to use. Carriers have long argued that the low interest rate environment we're in has an impact on our cash value products. And so, again, we wanted to change the 7702 because we wanted the ability to say, you know what, we should be allowed to use lower interest rates that are more reflective of the current interest rate environment. Now, that wish became true, again, with the passing of this change. So where a lot of carriers were forced to project, 4% or if not higher, we can now use a lower interest rate, i.e. like 2%, on a lot of our cash value products. So what does that mean? That means that we saw an increase in the guideline level premium, in the guideline single premium, and in the CVAT corridor. In short, plain English, this means more cash value. And for income scenarios, you're going to see better income. Now, carriers have this year to update their products for this, and that's going to be, a big change. So it's not like, even though this bill was passed overnight, it's not like the changes in carriers' products is overnight. Again, it's going to be here in the next several months. You're going to see carriers update their product portfolio to reflect this. You're going to see this changes on whole life products, on IUL products, on VUL products, especially. And so for North American, we don't have a whole life product or a VUL product, but we certainly have IUL products, and you're going to see our updates in respect to the 7702 later this year. I believe the first carrier to market with a product was Symetra last week. So again, This is great for the end consumer because it means I could fund an IUL for the same amount I was funding it a year ago, but now I'm going to have better cash value. How am I going to get better cash value? Well, that means that the death benefit, the face, is going to come down on those max funded scenarios, allowing me to achieve better cash value, right? There's some other things, though, especially from a carrier's perspective, we need to think about. Again, like I said, for the end consumer, 7702 changes are a good thing, but what else are we going to see? Well, like I just mentioned, you're going to see a decrease in face amounts. Now, that means better cash accumulation, but someone who was maybe purchasing that cash value product for a higher face, well, they're going to see that decrease. Another thing you're going to see is something that's directly tied to the face amount on life insurance policies. Targets are going to be decreased. Like I said earlier, Symetra last week was the first carrier that I know of to make 7702 changes, and we saw with their IUL that targets were decreased, I believe, on average about 35%. The reason targets are decreased, like I said, the face amount is coming down. Well, a lot of people are saying, well, why can't carriers just flip a switch and increase targets? They know that the face is going to come down. Why can't they just build their products so they double the target? Well, it's not that simple. As you know, the cost of insurance charges are based on the face amount, and so when face amounts decrease, that means a decrease in charges, i.e. revenue, to the carrier. So carriers are going to see less revenue coming in with lower faces. So it's not as simple as carriers being able to produce higher targets, right? Where's that money going to come from? So I really think here in the next several months, as carriers continue to develop these 7702 compliant products, you're really going to see carriers, ask some deep questions about where do we want targets to go? How is compensation going to be based? I think all carriers want to pay agents and producers fairly for these products, but because revenues are decreasing, we need to figure out how, is it going to be more a levelized comp, spread comp? I think more to come on that. Like I mentioned, Symetra, I know, launched their product. There's a decrease in target, but I already know they're going to the drawing board to figure out what's the next iteration of that. More to come on North American's front. Here in May, we're going to be launching our 7702 compliant Builder Plus 3 product. At the end of the day, I think it's going to be a balancing act, right? We know that for the consumer, 7702 changes are great because it means cash value. But for carriers, right, they need to figure out how to balance that, right? How do we balance what we pay producers? How do we balance things like target premium? And I think more to come along those lines. Like I said, I just wanted to brief you on some of those regulatory changes that we saw in the IUL space. Next, I want to cover something that is unique to North American, and that's what we did several weeks ago, is launch our new volatility-controlled index on our Builder Plus 2 product, and that's the Fidelity Index. Specifically, it's called the Fidelity Multi-Factor Yield Index 5% ER. And like I said, this is a volatility-controlled index. Going back to our product positioning, all the way on the left, that's where North American was in a pre-AG 49A environment. Once those changes rolled out, North American went from number 11 to number 5 in competitive position. Then on January 25th, we launched our Volatility Control Index, and our IUL went from number 5 to number 3, right? So only one carrier was ahead of us, and that was Global Atlantic. And what did Global do about 2 weeks ago? They decreased their caps, thus allowing, where we find ourselves today, North American to have the number 1 IUL product. Now, that's not going to be across every single cell, every single age, every single scenario, of course. But using our benchmarking here, which I believe is looking at a 45-year-old, you can see how we rank in terms of retirement income. And like I said, even though it won't be across every single cell, you will find us be extremely competitive across all cells. And again, I want to speak to this volatility control index and really how it help position us for that increase in income. The multi-factor index speaks to these 6 different factors here. It's well balanced at any given time. This index can move to be more weighted towards treasuries or cash. So in an environment where you might see the S&P 500 annual point-to-point index maybe return a 0, right, because it hits the floor, this index, because of its capabilities to diversify and move, can achieve a positive return even in an environment where the S&P 500 achieves a negative return, or in our case an IUL that hits the floor. If you want more information, there's that website below that you can go to explore more information on this Fidelity Index. Speaking to the multi-factors, again, that's how those 6 factors are divvied up there. But really what I want to get to is this, because this is probably what I get the most questions on when people are illustrating our volatility control index and Fidelity Index. A lot of times they'll say, Andrew, the max illustrated rate that I can use the Fidelity Index when I'm illustrating on WinFlex or North American Software is 5.63. But if I use your annual point-to-point, I can illustrate 5.91. Why wouldn't I illustrate 5.91, which is higher than your 5.63 on the new Fidelity Index? The reason being is that our annual S&P annual point-to-point index, there is an asset-based charge, which you can see here, the ABC, is 80 basis points. Meanwhile, on our volatility control index, that new Fidelity Index, the asset-based charge is 0. So really that 5.91, although it seems higher, the net amount is lower than the 5.63. Well, how can we do that? How did we take that asset-based charge of 80 basis points and reduce it to 0? The reason being is that with volatility control indices, the option costs to a carrier are much lower. And so we have dramatic savings when purchasing option costs on that volatility control index, which means we can pass on those savings to the consumer, which is exactly what we've done here by reducing that asset-based charge, again, from 80 basis points on the Builder Plus to 0. Why would you use a volatility control index? So if you're saying, Andrew, I get that you have this new index, I get that it has a 0 asset-based charge, but why would I use it when illustrating, for my clients? What's the value in this index? Simply put, it provides stability, diversification, and performance, right? So while an S&P 500 annual point-to-point index might have higher highs, you're also going to experience lower lows, whereas the Fidelity Index is going to be more steady. Like we looked at earlier a few slides ago, the diversification across asset classes, the different sectors, and like you'll see here in a minute, the performance is stronger on this Fidelity Index. When we back tested it, looking at the last 10 years, you can see here in the middle, that's the S&P 500 annual point-to-point with our current cap of 9.5%. And the 10-year look back would provide an average of 7.53 versus our Fidelity multi-factor yield index, which does not have a cap. It's 135% participation rate. And the 10-year look back on that is 9.37. So again, you can see that the performance on the volatility control index outperforms the S&P 500 annual point-to-point. But here's a better analogy that I like to talk to people about or give when I'm talking about why you would use a volatility control index. And again, those of you who sold cash value products for IUL before know the value in having a client attain steady returns, right? So here on the left, as you can see, is a picture of Babe Ruth, who in 1923 held the record for the most home runs in Major League Baseball that year, right? A lot of people know Babe Ruth as being a great home run hitter. What most people don't realize, though, is that same year, he also held another record, not just for most home runs, he also had the record for the most strikeouts. Meanwhile, on the right here is a picture of Ty Cobb. Now, most people don't remember Ty Cobb for being a great home run hitter, and that's because he wasn't. In fact, in the 1920s, he averaged, I believe it was about 5 home runs a season. So nothing compared to, what Babe Ruth did with his records in hitting home runs. What we also know about Babe Ruth's home run records is that they've since been eclipsed. Meanwhile, Ty Cobb was known for getting hits. In fact, to this day, he has the highest career batting average of anyone in Major League Baseball. And so when you think about it, right, if you were to think about this in terms of the indices that I just talked about, the S&P 500 annual point-to-point, will it provide higher highs? Absolutely. But you also get lower lows. Meanwhile, the Fidelity Index provides a more steady, consistent return year in, year out. Years where the S&P annual point to point will hit zero, the floor, you can still achieve a positive return in the Fidelity Index. And so wouldn't it matter to your customers, to the end consumer, that when they get their annual statement from their Index Universal Life product, that they see some sort of return, right? It's not always going to be home runs, but there'll be doubles, there'll be triples, and sure, the occasional home run. And like we saw in the back testing over the 10 years, which index outperformed the other. Now that we've talked about, some of the regulatory changes that we saw last fall and early this year, as well as that new Fidelity Index, I want to talk now about some opportunities that I see in the months to come. And to lay the framework for this, I really believe that 2021 is a perfect storm for life insurance-based opportunities. When we think about the markets and the economy, right, we know that something we saw last year was volatility in the markets, right? And I think it was March 23rd was the low point, right, for the market, and we had a huge run after that. But nonetheless, clients saw volatility. In fact, no one knew on March 23rd we had hit the bottom. There were a lot of people, in fact, that thought it was going to go lower. A lot of people moved their money to cash or to the sidelines because they were afraid of the volatility. And when we see volatility, when we see uncertainty about the economy, people are afraid naturally, right? Even today, with the COVID response, we're seeing that the impact that COVID has had on the environment, it's not going to repair itself overnight. There's still large sectors of the economy that will take a while to bounce back, especially, in the hospitality industry and travel. When we think about consumer needs, right? I think COVID has had a big impact on that as well, because consumers are thinking about their own mortality. They're saying, you know what, COVID has made me think about the fact that I could die, that I certainly, all of us are going to die at some point, but a lot of times we put it on the back burner, and we put the planning around our own mortality on the back burner as well. But I think, again, COVID-19 has brought that to light for a lot of families and individuals to do the planning they need to do today. If we look at the current administration and fiscal policy, I think that's going to provide a lot more opportunities related to life insurance sales, because with the new administration and new fiscal policy, it's likely that we're going to see higher taxes. Now, even prior to the Biden administration, I know that a lot of people believe, regardless of what side of the aisle you were on, that taxes had to go up in the future, right? Provided the amount of debt that we have as a country, historically low tax rates, it only makes sense to meet our obligations in the future that taxes need to go up. And I think with the current administration, you'll probably see that escalated to some point. And so what this really provides, again, is a framework for insurance-based wealth management solutions. Clients, again, are thinking about their own mortality. They're hungry for a product that can provide them peace of mind as it relates to that. But not just that, a product that can also provide diversification, not just diversification in asset classes, but diversification as far as taxes go. And also a non-correlated asset, right? Something that is not tied to the ups and downs of the market. So first, let's look at a protection opportunity. And when I think of protection opportunities, I think that clients who are leaning towards this type of opportunity are typically, they're going to be older clients, right? So I'd say 55 years of age or older, and they're thinking about death benefit, right? So they're not really accumulation focused. They're saying, you know what, I'm more concerned about what happens when I pass away. What am I going to leave behind when I pass away? What is my legacy going to be? How am I planning my financial situation for my family, for my heirs, for my beneficiaries, whoever that might be, right? And the great thing about protection opportunity is if you're a producer who does a client review, it is really easy to uncover this. And by the way, if you're not doing a client review, I would encourage you to do that. Maybe you're doing it annually. Maybe you're doing it this time of year, towards the beginning of the year in Q1, and you're saying now's a good time to revisit my existing clients. Maybe it's an existing client who you're reviewing their life insurance policy for. Maybe it's a potential client, and you're saying, you know what, here's what I do. I understand you have a life insurance policy. I'd love to take a look at it. The worst thing, and I tell people this all the time, the worst thing that can come from a client review is that you tell that client that the policy they have is doing exactly what they intended it to do. And all you're doing is affirming the fact they've got your expert advice affirming that the policy they have is a good policy. Now, 8 times out of 10, and I say 8 times out of 10 because those are the statistics that we see when people do client reviews, you can uncover an opportunity. And that's because a lot of clients, if they bought old adjustable life policies or interest rate-based policies that were sold when interest rates were extremely high, a lot of those policies are blowing up, they're falling apart, they're not doing what they were intended to do because interest rates have come down dramatically since the client bought that policy. So there's an opportunity to rescue or save those policies. Maybe it's a client who you can put them in a policy today that'll give them a higher death benefit for the same premium they're paying. Or maybe you get them the same death benefit they have for lower premium, so you can save them money. Maybe it's a client who doesn't have living benefits because they bought their policy, maybe it's the old type of insurance that didn't have living benefits at that time, and you can put them in a policy that includes living benefits. Whatever the case is, right? It's just a matter of asking them, what are your goals? Why did you buy this policy? I'd love to take a complimentary look at it and see if there's a way I can save you money, give you more bang for your buck, provide different opportunities, or better achieve your goals. And again, the worst thing that comes out of it is you tell them the policy they have today is doing exactly what it needs to do. When I say CCT here on this bullet point, that refers to North American's trio of living benefits, which are included in all of our products: term, GUL, GIUL, accumulation IUL, and that's our critical, chronic, and terminal illness rider. Again, those are included on our entire product portfolio, and we find that a lot of clients are driven to that because they want policies, life insurance policies that include that. Here's an example here of using a protection opportunity. We've got a 6-year-old female, right, who's got $1 million of invested assets. Maybe you have a client like this. Maybe you know a client like this who has money that is, AUM, assets under management type money that's tied to the market. But really, this client is not using this money for income. They've earmarked this money, right, to be part of their legacy. Maybe this money is going to go to kids, grandkids, charity, you name it. And so is there a better opportunity, or is there a life insurance opportunity related to this type of scenario? Absolutely there is. In the example here, this advisor, this producer simply says, you know what? I'm not going to ask you, client, to take out your checkbook and write a check for life insurance. All we're going to do is reposition some of the assets that are already under management. So we're going to take 3%. We're going to leave 97% of your funds exactly where they're at. We're going to take 3% over the course of 10 years. So we're not even going to do it for your lifetime, just 10 years. We're going to take that 3%. We're going to reposition it to life insurance because you've told me your goal is to pass on a legacy, right, to your heirs. And that's what this money is earmarked for. So we're going to take 3% over 10 years. We're going to buy guaranteed, because guarantees are important, we're going to buy guaranteed death benefit life insurance product. On the bottom here in that blue line, this is the client's $1 million, assuming a 5% rate of return, if she does nothing, right? She just leaves the assets there. Over time, they will continue to grow, absolutely. But if she takes 3% and repositions that to life insurance, you can see in that green line how that portfolio combined with life insurance outperforms that blue line down below. And so immediately you've given this client leverage that she says, oh my gosh, this is great, because if I pass away, the people that are counting on me, right, my kids, grandkids, whoever I want this money to go to, they are going to receive more money by repositioning these assets to some of these assets to life insurance. Not only that, it includes those living benefits I mentioned, the critical, chronic, and terminal illness rider. So if she gets sick, she can tap into that death benefit to help offset some medical expenses. What happens to her portfolio if the market takes a dive, right? That blue line is going to go down. What happens to her death benefit if the market goes down? Absolutely nothing. It provides some volatility protection. And last, certainly not least, life insurance also pays a tax-free death benefit, so that will pass on tax-free to her heirs, avoid probate again, and avoids taxes. Now, over the course, it's about year 30. If she were to leave her money purely in the market and it assumes that positive return, yes, it will outperform the portfolio combined with life insurance. But a few things. One, this assumes that she's going to live well beyond a life expectancy to achieve that positive return. Two, we're assuming that the market actually gives her that return. But I would argue that the protection you've given her in the early years, the peace of mind you've given her in the early years, that volatility protection, the living benefits, far outweighs the fact that 30 years or at some point in the future, that portfolio solely in the market, would outperform the portfolio with life insurance. I would argue that you're still better off combining your portfolio with life insurance. Here's another opportunity when we think about protection, right? It is, again, protecting a legacy, especially for these older clients. I've seen this opportunity. I saw it a lot last year, and I imagine we're going to continue to see a lot in 2021. And that's, as many of you know, when the passing of the Secure Act happened, and that went into law at the beginning of 2020, what did that do to the stretch IRA, right? So the stretch IRA, again, impacted those who have qualified funds, IRAs, where they've named a non-spousal beneficiary. So think of, I've named my kid, I've named grandkids, I've named even a trust. All those were impacted with the passing of the Secure Act. Now, prior to the Secure Act, in our example here, you've got Anne, who's a mother of 70 years old, and she's earmarked her qualified IRA of $250,000. She's earmarked that to her daughter, Grace, who's 40 years old. Now, again, prior to the Secure Act passing, if Anne would have passed away, that qualified IRA would go to Grace, and Grace would have the rest of her life to take that money out. And so the benefit of that, and that's why we call it the stretch IRA, is because she would be able to stretch that out over the rest of her life. The benefit of that is we would see very low tax impact to Grace, because as she stretches that out over the next 40 years and draws income, again, the tax impact would be minimal. But with the passing of the Secure Act, that stretch IRA was eliminated. And now where we find ourselves today, if Anne were to die and name Grace as a non-spousal beneficiary, Grace would just have 10 years to take the money out. And so the tax impact of that would be far more dramatic than in a pre-Secure Act environment. Instead, we're finding a lot of people repositioning these funds to life insurance. And the reason they're doing that is they're saying, you know what, the stretch IRA was a great legacy tool when we had it, but we don't have it anymore. We've got to find another solution, and that's life insurance. And so again, using the same example with Anne passing the money to her daughter, Grace, if Anne were to say, you know what, I'm going to take this $250,000 qualified IRA, I'm going to take the money out, I'm going to pay my taxes, we're going to assume a 25% tax on that. She uses the net amount to buy a guaranteed death benefit life insurance product. In this case, we're looking at our Protection Builder IUL. And now, when Anne dies, Grace would receive a $336,000 tax-free death benefit. So if I'm Grace, would I rather get $250,000 that hasn't been taxed, or $336,000 tax-free? Well, of course, you would opt for the latter. Meanwhile, Anne, what does she benefit from? Not only the peace of mind and knowing that she's not going to burden her daughter with a tax scenario, but again, because she owns that policy, it has living benefits. So she needs to tap into that because if she gets ill, Alzheimer's, dementia, anything like that, she can utilize the policy to offset some of those expenses. And again, this is something that we saw a lot of in 2020 with the passing of the Secure Act. A lot of people that were in this situation found themselves using life insurance plans. So again, as you're doing client reviews, as you're talking to your clients, make sure to ask them, do you have an IRA? Who is the beneficiary? And what is the purpose of those funds? The product that I highlighted, again, it's called our Protection Builder IUL. It provides guaranteed death benefits. I know a lot of carriers are pulling away from guaranteed products. North American is not. We're reaffirming our commitment to the guaranteed space. So this product can guarantee all the way, you can dial that guarantee all the way up to age 120. It's on an IUL chassis, so it provides that cash value potential. That new fidelity index that I just mentioned is available on this product as well. It includes that living benefits of critical chronic terminal illness rider. Something that I didn't mention, but the product does have is a neat return of premium feature. So if the client wants to walk away in year 15, they can get 50% of their premiums back, or in years 20, 25, they can get 100% of their premiums back. Again, so even if the IUL were to bomb for the next 20 years and there's zero cash value, which is highly unlikely, but let's just say that happened, the client can still walk away and get all their premiums back in years 20 or 25. So it's a nice little exit strategy the product provides. Moving on, we'll look at, just looked at protection opportunities. Now we're going to look at accumulation opportunities. And now accumulation opportunities, especially as it relates to IUL, I'm seeing a lot of this primarily with high income earners. And the reason being is that these high income earners are already maxing out what they can do in a qualified plan, right? They're likely contributing all they can to an IRA or their employer's 401k program, but it's still not going to be enough for what they're going to need in retirement. And so they need an additional bucket, an additional source of revenue in retirement, and life insurance can be that for a lot of these people. Business owners, I would say that some of the largest cases, if not the largest cases that I saw last year, had some sort of connection to a business. So whether it was, key person, executive bonus, just personal retirement planning for business owners, we saw a lot of that, and I think we're going to continue seeing that going forward. Typically, when you look at accumulation opportunity, it's going to be younger clients, right? So you're not going to see clients that are 70 gravitate towards this opportunity because they don't have a lot of years ahead of them to accumulate and distribute that wealth. Typically, they would have already accumulated it. Again, so these accumulation opportunities are going to be for those, I think, that are in their prime working years. And they're looking for, like I mentioned earlier, tax diversification or asset diversification. The example I'm looking at here is actually, like I said, some of the largest cases that I had last year experience were in the business market. And here, I've actually taken a real life scenario, just changed the names a bit, but this was two of the largest cases that I worked on last year. So on the left, we're looking at a CEO, right? Jimmy CEO, 40-year-old male. He owns his own tech business, and he wants a supplemental retirement plan. Now, why does he want a supplemental retirement plan? Because Jimmy is already maxing out what he can do in his 401k. Again, it's not enough, which is something we hear a lot of from high-income earners. And so he's saying, is there something I can do to further put money away for retirement, because I know that I'm going to need supplemental retirement income in addition to all, what I'm already doing in qualified plans. At the same time, as a CEO, he has a key person here in Peter, who's one of his tech developers that works for the company. Peter's a 35-year-old male, and he has developed an app that has really led to a lot of the growth this business has seen recently. And so Jimmy, as a CEO, is saying, you know what, the last thing I want is for Peter to walk away from this company. I don't want him to get another offer from another company. I don't want him to work for the competition across the street. I need to figure out a way to retain him. And so he's implementing what we call an executive bonus, or oftentimes people will call a 162 bonus. Now, going back to Jimmy and his personal solution, again, he can max fund a life insurance product for supplemental retirement income. It provides tax diversification. So Jimmy might say, you know what, I'm worried about taxes going up in the future. I'm worrying about what a new administration might do to taxes. And so is there a way that I can put money away that'll grow tax deferred and that I can take tax-free income from? Absolutely, life insurance. In addition to that, Jimmy doesn't want a limit on contributions. He already has a limit on his 401k. He wants a plan that says, you know what, I want to put in as much money every single year as I feel like putting away. Is there a solution for that? Absolutely, life insurance. Creditor protection, we see a lot of business owners are worried about that because they don't want people, whether it's involved in lawsuits or not, coming after the assets of the business, right? Well, the benefit of life insurance in most states, and you have to check on your own state laws as it relates to this, but in most states, the cash value that's tied inside a life insurance product is protected from any creditors. So again, this is really important to business owners when they're doing this type of planning. And of course, I don't want to fail to mention that living benefit trio, the critical, chronic, and terminal illness rider, also included on that product. Meanwhile, what can he do for Peter? Well, again, we mentioned that executive bonus. And how does that work? Well, how that works is the business will purchase a life insurance policy on the life of that key individual, which here is a tech developer, Peter, right? And so the benefit for the business when it does that is it says, you know what? I was worried about losing Peter to the competition. I was worried about, finding a way to incentivize him to stick around. I can do that now with this policy. I can retain him, I can reward him, and hopefully someday he can stick around long enough that he wants to retire from this company. In addition to that, I, the business, also get a tax deduction when implementing this plan. And for Peter, he feels special because when a company puts one of these plans in place, he says, man, now, they've shown me that they want to bonus me X amount, for the next 10, 15 years in this life insurance plan. I really want to stick around because I know that money can grow. I know what it means to me. I know what it means to my family. I know what it can mean to me in retirement. And the ability to grow that money tax deferred and take, the income tax free is really important. So again, it incentivizes Peter to stick around. It's an additional bonus for him on top of the work that he's doing. And for the business, again, they have peace of mind knowing that they've sort of golden handcuffed Peter to the business. He's not going to go anywhere anytime soon. And by the way, we get a tax deduction on top of that. The product that I'm highlighting here is our Builder Plus 2. That's our Accumulation IUL product. I won't go through every single bullet point here. Just suffice to say that it's extremely competitive, right? On the rankings that I showed you earlier, you can see that it's currently number one in the income scenario space for accumulating and drawing income. It's got a lot of unique features that other products don't have, like the fact that we do a minimum account value, 2.5%. We have an ROP death benefit. We have the highest premium deposit account PDA in the industry at 3.25%. Protected death benefit, no other carrier has that as well. We've got a contractually guaranteed multiplier, a contractually guaranteed bonus. We've got that new fidelity index that I mentioned, again, is available on this product as well as that protection builder product I highlighted. And last year, as you likely see if you sold this product before, we increased the compensation to you, the producer, to make it one of the highest paying IULs on the market today. So where does that leave us in closing? Why is 2021 a great opportunity for tax advantage solutions? Simply ask yourself this question, or maybe ask this question to your clients, right? Where do you think taxes are going to go? Where we find ourselves today is at a historically low tax rate environment as it relates to individual income tax rates, right? You can see in this chart that there's only twice the taxes were lower than they are today. The first being in the Great Depression era, and then the second being in the late 80s. But I would argue that where we are today, relative to the amount of debt we have never been in this sort of environment, right? Where it's 27, nearing $28 trillion in debt that we have in this country. How are we going to pay those obligations going forward? I really believe that taxes are on sale today. And so now is the prime opportunity to do this planning. Now is the prime opportunity to ask your clients, are all your eggs in one basket, right? Is all the money that you have in a qualified plan that is going to be taxed later in life? Because if all your money is in a plan that's going to be taxed later and tax rates do go up in the future, then you've done nothing to diversify your retirement income and your retirement situation. Instead, if you put some of that money in a tax-free vehicle like life insurance, then you can diversify your retirement income and not be so concerned that if taxes do increase in the future, which again, most people agree that it's likely going to happen, then you know that some of my money that I've allocated is going to grow tax deferred, and I can take income tax free. Now, asking that same question, right, where tax is headed as it relates to protection type scenarios. Let's look at the estate tax rate. You can see here the exemption, right, which is are that dark blue bars. The federal tax rate, estate tax rate exemption has never been as high as it is today. And so what that means is I can die today with a extremely high estate tax, value or estate value, and the large majority of that is not going to be taxed. In fact, I've got to have an estate over, likely over $12 million before I see any federal estate tax. So that exemption is extremely high, right? It's never been as high as it is today. Meanwhile, the estate tax rate, you can see, is that line, and where we find ourselves today is a really low rate of 40%. You can see in 2011 is really the only year that it really made sense to die, right? Because you could die, and there was basically no, 0% federal state tax rate exemption didn't apply. So if anyone were planning to die, that would have been the year to die when you weren't really impacted. But where we find ourselves today at a historically low estate tax rate with a historically high exemption, that begs the question, what's going to happen to estate taxes? I think a lot of people are in agreement, especially with the new administration, that you're going to see that exemption come down. When that exemption comes down, that basically means that you don't have to be someone with a 10, 11, $12 million estate. You might see this impact people who've got $1 million, $2 million, $3 million, which a lot of people in their retirement accounts, especially when you add on, their houses, it doesn't take a whole lot to get over that. So we find ourselves, again, with a low estate tax rate exemption, which we could find ourselves in with this new administration. And if the estate tax rate gets increased, life insurance is a great way to have clients offset those taxes by using a guaranteed life insurance policy. So in closing, what do these solutions really provide? Well, for the clients, this is an opportunity to protect their legacy. It's an opportunity to accumulate wealth. It's an opportunity to diversify their tax situation. And for you, the producer, I hope that this is an opportunity for you to engage your clients, to identify solutions that will work for them, to ask questions, to offer to do a policy review, to find out if they're well diversified as it relates to taxes, as it relates to retirement, as it relates to their estate tax situation. And I would encourage you to take these next steps, right? Identify clients that you're currently working with, or maybe it's someone that you want to become a client, prospective client, and have a conversation with them about one of these concepts. Maybe it's accumulation focused, maybe it's protection focused. Work with Imes. As Tony mentioned, you have him as a resource. You have Justin Ford, you have Jess Riley. They are all there to help you grow your business and find life insurance-based opportunities in 2021. Work with Imes on any illustrations you need, marketing support, product material, anything that I reference, right, related to our Protection Builder product. If you need information on our Builder Plus 2, if you need information on our new Fidelity Index, whatever it is that you need, the team at Imes is ready to help you out. And last but not least, present that solution to the client in an effort not just to put them in a better situation and a better place, but help you grow your business, help you make some more money in 2021. So with that, I will turn it back over to Tony. And again, thank you for joining us this morning, and thank you for the time.
Andrew, thank you so much. I do have a few questions that I want to get to here before we end this webinar. Hang on just a second. Let me switch back to me. Okay, can you see my screen?
Absolutely.
All right. So, all right, hang on just a second. Let me get to that here. Hang on. I apologize.
While you're pulling that up, Tony, I would just say that I didn't get an opportunity to vote on that cruise you were showing earlier. So if there's a way to throw my hat in the mix there, I definitely want to vote yes on that.
You know what? I can talk to Steve about that one for you.
Sounds good.
All right. I did have a question here that I wanted to get to, but there's some stuff in here that I'm trying to get through. And I apologize for the delay here.
No worries. Again, while you're looking that up, I talked about this topic here the last several weeks and just getting an enormous amount of feedback. Because, again, I think regardless of what side of the aisle you're on, I think a lot of people are in tune with this. And really, it's a conversation they want to have with their clients, right? They know that the new administration is already working on some legislation that they want to push through both houses. And what we're going to see is likely an increase on individual tax rates, likely an increase on estate tax rate and a lowering of that exemption. So I think it's an important conversation, right? And while it impacts people probably in a negative way, right? Most people don't want higher taxes. For those of you selling life insurance, it really is a door opener. It really is an opportunity. Really is a chance to have that conversation with your clients.
All right, looks like I don't have it here. I had some spam going on here, and
Yeah. Well,
now
no
it's
worries. I mean,
gone.
if anything does come up, I'm happy to, you know, respond to people individually if you do get any questions. So don't hesitate to let me know, and I'd be happy to circle back with people one-on-one and address any questions you might have.
Awesome. So let's do this. So got two more polling questions that I'm gonna go ahead and put up here. The first one being is if you'd like more information in regards to today's webinar, I'm launching a polling question here. Please respond to that. We'll definitely be able to get some additional information out to you. So we'll leave this up for a little bit and have you respond to that. All right, looks like we've got quite a few that want some more information, so definitely get some more info out to you. And then lastly, the one that we really like is if you're not appointed with North American and you want to get appointed with them, we definitely like to get you appointed. So have a polling question there. Please respond to that. Make sure to get you the contracting request information and get that taken care of for you. So I'll leave that up for a little bit longer. All right. So close that out. And lastly, for this content and any other content you would like to be able to have access to, you can follow us and like us, whether it be on our Facebook page or our LinkedIn page. As you see here, we do have a Facebook page as well as LinkedIn page. Try to provide all that content, make that available to our advisors on both of those platforms. So with that, Andrew, do you have any parting comments?
No, just thank you, Tony, for the time. I appreciate everyone who tuned in today. Thank you for the opportunity to talk about this and share a little bit about North American this morning.
Andrew, thanks again for your time. Everyone else, do appreciate you joining the webinar. For those of you that needed additional information, we'll make sure to get that out to you today, as well as those that are looking to get appointed. So everybody have a great week, and we look forward to our next webinar. Thank you.